Great. We're live. Hi, Tony. Welcome to Venture with Grace.
Hey, Grace. Great to see you. I'm glad we worked through all that technical stuff.
I know it was completely. It was life is very challenging. By the way, it's that was like a journey basically. Okay,
Well,
so
we
I
did it.
was. Yeah, I know. High five, air five. Um, okay, so let's start with like, okay, so I was like binging through your podcast from like literally 10 years ago of how you moved to France. And maybe we could start from there. Like, you work as a brand manager at Danone, and then you founded two companies that were acquired by AOL, and you have spent like over 20 years at True Ventures. What are some key lessons or like core takeaways from your career early on that kind of changed your life trajectory later?
Yeah, definitely. There's so many things, right, that
Mhm,
that add up. But we can start off professionally with my career at Danone. Danone was really like the springboard to a
mhm,
lot of great things. I think that have, or a lot of great exposure for me.
mhm,
Um, it taught me a lot. There's lots of tactical things that I learned. I learned things about brand management, P&L
mhm,
management, the value of brand, how to work across different disciplines, different partners, both inside the company, outside the company, how to motivate, how to lead, all those kinds of things. But my particular journey, I was very fortunate to be offered an opportunity to live abroad.
mhm,
And so I spent time in India about a year. I spent a little bit over 4 years in France and then about 4 years in Indonesia. And I learned so much about myself in that period of time. I
mhm,
gained a lot of confidence. I learned a lot about self advocacy. I'd never really thought about that. We probably all self advocate at a certain level, but in that kind of environment where you're kind of this you're a little bit of a shiny object, you're a little bit of a, they're moving you abroad because they either you fit into maybe like a company mission and desire
mhm,
and goal, but maybe they don't actually really understand how to act upon that. So for the case of Group Danone, they were becoming an international company and they really had global aspirations, and so they wanted to have uh, people moving from France to the U.S., from U.S. to France, and all around the world,
mhm,
right? Make it a truly global company. But I
mhm,
don't think they really understood how to do that. And
mhm,
this, we were part of the first cohort of those people, and somewhat guinea pigs in a lot of ways. And so, as an example, when I got to France, it dawned on them that I didn't really speak French all that well.
mhm,
And so instead of like coming up with solutions, they just kind of let me sit over there idle in a weird corner. And finally, I said, enough is enough after a month. Like,
mhm,
I didn't, I feel horrible about myself. I'm not, I
mhm,
feel like a charity project versus, doing some good. And so I just went to them and said, listen, I need to do something where I'm really perfecting my French. And I need to go do something maybe in sales. And they
mhm,
said, well, you don't speak French well enough to do sales. I go, exactly. That
mhm,
is the conundrum. So let's figure that out. So they put me in merchandising, which was still one of the best and oddest jobs I've ever had in my life. It's a job that meant going to work around 10 o'clock in the evening when grocery stores were closing, cleaning their shelves, moving everything off, and then kind of resetting strategically around a way to optimize the revenue on the shelf. So just flows, number of facings, all the technical jargon of CPG and all that kind of stuff. But the great thing about it was I was standing there for about 6 to 8 hours every day with somebody who absolutely did not speak French, from that, or excuse me, did not speak English. And all we did was converse, and they were very tolerant, and the bar was much lower. And I gained confidence little by little. And eventually I was able to go back to Paris and do my job correctly. But that taught me a lot. It taught me about standing up for myself, right? Had a similar
mhm,
experience in Indonesia when I arrived there. I woke up at, I think I looked at my wife around 3 or 4 o'clock in the morning. We were jet lagged, woke up in our hotel, and I'm like, I don't have a clue what I'm supposed to do. And
mhm,
there's nobody here. I'm the first one here, right? And so
mhm,
I just figured out, well, we must have partners, people like Price Waterhouse or consultants or whatever it is. And maybe I can just tap into that network and kind of get going. And so I did that. So I learned a lot about being a self-starter. That plays a huge role in lots of different personal and professional junctures of my life. Certainly when I started a company, it definitely, you got to be a bit of a self-starter, and you got to figure things out right for yourself. So anyways, Danone was great. I have nothing but magical and wonderful things to say about them.
Totally. Okay, so I have so many questions about your resume, not like question about them, but it's more of like I'm impressed by like stuff you have invested. I feel like being an SF local, first of all, like Blue Bottle, I wanted to make sure I bring in my coffee mug here. I was there yesterday, but this is like, I mean, I already finished today's coffee, but I just wanted to bring this. So you have invested in Blue Bottle, you have invested in like Sweet Green, and then honestly, like, like I was not expecting the oyster teapot, like flour and water and Trick Dog. I mean, I saw Trick Dog somewhere. How do you how do you get into like hospitality? This is like intense hospitality.
Yeah. Well, I've obviously
Those
always
are like, by the way, I wanted to give the audience some like background. Those are like iconic places that you eat in SF or drink in SF. I was literally trying to host my like startup like happy hour at Trick Dog. It's very expensive. But anyway, okay, let's like talk about like, how do you get involved with all these like hospitality stuff while being an investor? I mean, we'll get into the WordPress or something later, but
yeah, definitely. I mean, so there's things in there that are personal. So in the case of Flour and Water and Trick Dog and Flour and Water Pizzeria, Penny Roulette, those are personal investments, right? Those are not things we did at the fund level. Sweet Green and Blue Bottle, luckily, we did do at the fund level. And so I've always had a fascination, obviously, with all things consumer, all things brand. Certainly, the food space and hospitality space are things that interest me. And so it was really, really natural. And I find that those kind of brands are cultural, right? I mean, Sweet Green a little less so. Blue Bottle, though, is absolutely cultural. There's an entire world of artisanal based coffee shops that now exist because of James Freeman's vision around this space. And every time I walk into a cafe, almost anywhere in the world, if it's like a really good cafe, they kind of know, like they kind of like, oh, like, and it's like, it's surprising because there's nowhere else I go in my life where I'm treated like a celebrity except for in a cafe. And I didn't even found the company. So I've always just loved those things. And, like when I first started, like on Blue Bottle as an example, it was just really kind of personal. I thought maybe it was something I would personally invest in, but the more that we peeled back the onion and understood kind of the cultural dynamics that were at play, and the opportunity, and was it possible that somebody could take 10% of the market cap of a, large company like Starbucks? The answer is absolutely yes, right? It's not typically what we do as venture capitalists. I hope we get to talk about other things. Everybody always wants to talk about Blue Bottle and Sweet Green and those things, and I'm proud of them, and we're proud of them as a firm. But, it's not typically what we do. It's more science-based, it's more SaaS, it's more of those kinds of things. But they were fun, and we realized that they could scale. 4Wall, I knew nothing about it. I learned a lot about it. We'll get into this. I know you have some questions around metrics and what you look for and all that. And we can talk a little bit about 4Wall if you'd like. But they're magical businesses, and Blue Bottle in particular is at the zeitgeist of culture. Like I grew up in a small little farming community in Indiana. If I go to the largest town or city in proximity, Fort Wayne, Indiana, if you go to a restaurateur who's kind of in the know and doing something kind of cool, I guarantee you they know about Blue Bottle and they know about Flour and Water. Like they just do. It's in the zeitgeist. So those things are really fun to have on the resume, so to speak.
Mm. I was wondering, so like for to evaluate Blue Bottle, I mean when I was like working as an associate, like I've seen like the tea version of Blue Bottle in China, but I feel like it's really hard to tell the differences between like company one versus company two.
Mhm.
Let's say I'm not sure, but like I guess like maybe let's say Phil's Coffee come to you, it's also Bay Area based, like how do you compare these two, right? Like when obviously no shade on Phil's at all, but I'm just saying like how do you pick the winner of the coffee category that would take the 10% from Starbucks?
Yeah, and by the way, Blue Bottle still doesn't have 10% of Starbucks, right? It's a long-term mission. You know, Phil's. Interestingly, Phil's was making the rounds in the venture community, and I do think some venture firms invested in it. And I don't know a lot about their business now, and it might be a fabulous business. I don't have any problem with Phil's coffee, but I think it's different, right? What I do know is Blue Bottle, and I know what attracted us to it, beyond the very large TAM, which is, a total addressable market, the size of the market, was James Freeman. And a lot of these things we'll get into are so founder centric. And it's about a founder that has such a clear, compelling vision of how their product intersects in your life. And they're almost, they just have blinders on. Like they don't really care what you think. They just know it's so magical, or they think it's so magical, the experience that you can have with their vision, that they're just going to transport you over here, right, and impose it on you. And hopefully they're right. you know so when I remember sitting down with James the first time, and I was just so blown away at how he had thought through every single detail. Things like simplicity of menu. Um, no, there was no Vente Grande, and it's not Starbucks is a fabulous company, so I don't want any of this to feel like I'm degrading them, because they're a fabulous company, but it was just really complicated, right? By the time you ordered your coffee, it kind of gone through like almost like a little 7-Eleven retail store. They were selling CDs, chips, all these other things. And you're ordering your coffee, and then you got, creams and different flavors. And it's just so complicated, I think, for a lot of people. And James just had this simple, vision, like it's going to be a pour over coffee. We're going to probably do a couple of milk-based things like a latte and a cappuccino. And I remember this one thing. It's so silly, but it told me about his attention to detail and about his adherence to his vision. He did not believe, and he still does not believe, that hot espresso drinks should be consumed on the go. Like it is, it is something that should be consumed not in a paper cup, but in a ceramic little cup. And yeah, much smaller than that, right? And thank you for having that. But he just felt like, if you can't take a minute to just enjoy and sip it at its optimal flavor and experience, then maybe you should go somewhere else, right? And not in like a mean way, but just like, that's just not who we are. And he really held on to that for so long. Now today we understand consumers are so mobile and whatnot. And as you scale a company, you have to be careful about not taking the guardrails off, but you find compromises, and you can probably get an espresso to go at Blue Bottle today. Which is great.
I wonder, so beside the experience and the attention to detail, can you give us like an example of like, beside the, simplicity of the menu, I guess like what does a pitch kind of look like for you? Because I feel like after hearing like so many founder pitch, a lot of people just pitch like how unique their product is, or how the experience is transformational. But like I think not many people would just immediately get traction from you, from other, we had another, well, I'm pretty sure Steve Jiang also invested in Blue Bottle. But like, how do you think about like, I guess like the differentiation between like 5 other founder who are also like, amazing go-getters in the space?
Well, let's switch from Blue Bottle because we'll be overly caffeinated if we keep
I know, right?
keep on
Yeah.
that. Let's take like one of my heroes, which is Matt Mullenweg, who's the founder
Mhm,
of Automatic and WordPress. And
mhm,
Matt, I've learned so. I mean, Matt in a lot of ways is like a mentor to me. He's much younger, luckily for him, but I've learned so much from Matt. And like his adherence to the principles, the core principles of open source and what that means. And trust me, when you have an open source company that scales to a very large,
mhm,
uh, position, such as WordPress, which I think is over 40% of all websites in the entire world run on WordPress, just to give you
mhm,
perspective.
mhm. My website runs on WordPress.
Thank you. When that happens, obviously it's open source code. And so there's lots of people that can come and they can take the code, go fork it and go do other things. And
Mhm,
it's uncomfortable. It's a really uncomfortable place to be. But that is his core principle for why he started the company and what he believes in. More importantly, beyond WordPress, just what he believes in terms of a life mechanism. And so, I've watched Matt over the years hit so many of these kind of rough, moments where somebody was misbehaving in the community, somebody was threatening to go do this or do that, or people built businesses on top. Just like it's complicated, and he's always handled it, navigated it with grace, consistency, and intentionality. And for me, those are the things that you look for in a founder. If you can find those kinds of things, high EQ, leadership, all the human things, right? And then this conviction to their vision and why it's going to play out and how it's going to play out, and not just when it's convenient for them, like when it's
mhm,
inconvenient sometimes. Sometimes that might mean stepping away from a business because you're no longer the right person to lead it, but you have conviction around it and you do the best for the business. That's what you want in a founder, always.
mm. I wonder, how do you think about this is like such a different topic, but like how do you think about valuations? Like, and I guess like how do you like thinking about as a fund, right? So like I know like True Ventures like kind of you guys don't attribute XYZ to different partners, and that's like one thing differentiate you guys from like other people. But also like I guess like first of all, like how as a fund, how do you think about portfolio construction? And then how do you think about valuation of different kind of things? So for example, a Blue Bottle is probably very different than Slack or other of your portfolio companies that sold to like Google, Adobe, and Salesforce. Um, I guess like how do you think about valuation as well as like portfolio construction? Do you invest in that one deal that's like created so much FOMO that's like valued at like a really crazy price, or how do you guys like kind of make decisions on that?
Yeah, no, just by nature of what we do, which is, we want to be the first
Mhm,
institutional check in a company. We're
mhm,
incredibly disciplined about it. We have 14 total funds, which that includes a couple of our select
mhm,
opportunity funds. And we have 9 what I'll call core funds,
mhm,
or excuse me, 8 core funds. But across those 8 funds, we've never had a median ownership under
mhm,
20%. And that's not me,
mhm,
gratuitously. Venture capitalists are famous for rounding up and
mhm,
doing
mhm,
things like that. We've
mhm,
literally never been at 19.99 or below. Like we've always been at 20% across
mhm,
ownership. Do we have exceptions? Of course. I led 2 deals on our behalf in the last quarter where we were under that number, right? As an
mhm,
example. So our valuations are always going to be, early, right? And
mhm,
so um, what I'll say to founders is be careful, right? These first initial rounds
mhm,
and the round that we're doing, and probably the round right after that we've done, you have to be very careful about not overheating your valuation because you create lots of roadblocks for yourself. You
mhm,
force yourself into different investor groups that maybe you're not ready for. You put a different kind of level of pressure on the business
mhm,
that is unhealthy and unnatural. And so, I always say, be careful. You might get what you ask for,
mhm,
and that may not be the right answer. We live in this culture where there's a bit, on one level, there's so much information, there's so much wisdom around what I'm saying here. And I think collectively, we probably all buy in.
Mhm.
And yet we're still in this culture of like, it's a game. Like, let's just get the max valuation possible. Let's get that unicorn early, like all that kind of stuff. Whoa, like slow down. Like this is not a game. This is about setting yourself up for long-term success with the right partners and the right pressure points and objectives at each stage of your development. Right. So, I eat my own dog food on this. As you know, I founded a few companies, and, I certainly could have probably turbocharged for sure the second and the third one. I could have easily turbocharged because I had success on the first one, the valuation, but I didn't. I mean, in that period, I founded my last business in 2009. I valued it at 4 million post. Now that today that'd probably look like about 8, million post. I guarantee you I could have done it at 20, 25, 30. I could have just inched my way up, but it would have created a set of pressures, and it also would have limited flexibility early on for potential M&A activity that might be the right answer for the business, right? We're in a power law business, as a community, but often you look at a business and you just go, you know what? It's a good little business. And like it should have a home and it should exist and probably would thrive within a large corporation. And I, unfortunately or fortunately built those kind of businesses where I had early exits and modest exits, but meaningful, changed my life and generated, great returns for my investors in a very short period of time. And I'm glad I did it that way. So that's how I think about it.
I wonder, so like, why is your business like, gotten acquired by, AOL? And like, how do you like, I mean, what's a reason for them to, I mean, obviously I know it's a valuable business, but I just want to like break down to the science because like not everybody could have an exit. And you have like demonstrated that you have like multiple exits, and then a lot of your portfolio company also having exits from different companies. Like, I guess like how do you focus on what would be the core value creation that you focus on at the very beginning as a founder?
Yeah, well, I mean, you have to create. I mean, so first of all, you shouldn't build a business to sell. I mean, ultimately,
Right. Yeah.
that's
Yeah.
part of the gig, and we all understand that. But I never woke up and, I mean, if I'm intellectually honest, maybe on my first one, it's like, hey, I want to make money.
Yeah. Yeah.
I'm tired of eating ramen noodles,
Grinding.
like whatever. But, for subsequent businesses and the way I invest, like that's never the goal. It's like, should this exist? Is it really interesting? Or are these people I want to work with and partner with? That's, those are the compelling things to chase. And so you have to have a real vision for your business, but once you get into it, there are lots of things that entrepreneurs forget to do. And I think I was particularly either lucky to just have done them, or I was smart to have done them, so get to know your competitors day one. Like actually, it's audacious, but maybe even show your competitors. I'm talking about public company competitors, not your small little startup competitors. There you want to be like, elbows out, be careful. But like I took Sphere, which was my first company. I took it down and showed it to the Google folks, and it was in search. I showed it before we launched. Literally, I showed it to AOL before it launched. AOL was a big company at that point, right? I showed it to Yahoo.
Oh, I have another question. So who exactly do you show to? Just because like, obviously, I think showing to the right person at the right time also, it's like so that they could track your track record is like pretty important. But what if the person leave or like wrong department, all that kind of stuff?
I think early on, I went and met with, on About.me, I met with Reed. And I said, here's what I see. This is what I think you guys aren't doing. This is what I think we're doing, whatever. LinkedIn never acquired our business. I think they probably looked at it, kicked the wheels on it, but like they never did. But that was the right thing to have done, right? And, it was interesting to them. And it shows already, it starts to establish a relationship an awareness of who you are. You get to present yourself. Everybody in those first meetings is going to put on their best, clothing and
Mhm.
present themselves in the best light. And so it's a great opportunity early on to start nurturing those relationships. Not with like I wasn't going to sell my business to LinkedIn, on that
Mhm.
meeting, and
Mhm.
I wasn't going to sell to Google when I went down there
Mhm.
was here, but I was planting the seeds already
Mhm. Mhm.
instinctively, and and it turns out that all those businesses got acquired.
And what would be the metrics that you should chase? Is that going to be like, okay, we got like 5 million people onboarded onto our platform, so we're kind of good to go, or like, we drive X amount of revenue, or like client base? Like, how do you think about the
Well, I
metrics
think
for
businesses go through different stages. You have concept
right?
market fit,
Hmm.
right? Then you have product market fit. Those are
Hmm.
very different things. I think most entrepreneurs don't understand the nuances
Hmm.
between. And then there are all the revenue and performance drivers
Hmm.
that indicate that actually you're operating with some level of operational excellence, right?
Hmm.
Against, so if you've unlocked, I mean, a lot of us have concept market fit when we start a business, right? We
Hmm.
already kind of instinctively know there's an opportunity. It's the product market fit aspects which are really hard to get dialed in. And there
Hmm.
you've got to look at usage behavior and how long is it, like on About.me, how long did it take somebody to set up a page? Did they actually do anything with the page? Did they come back? There's all kinds of things that you're looking for to say like, oh, it resonates, it's working, it's actually spot on what we wanted to do, and it's working. Then you've got all the executional stuff of bringing it to market.
Hmm.
And, can you actually acquire customers, efficiently? And is there high churn or is there not? Is there revenue or is there not? Do you have a natural organic growth, mechanism into the product? And there's all of those things, all those variables that you have to track. I mean, relentlessly. And you also need to know when to move off certain variables that they're irrelevant that you thought were, and when to bring new ones into the mix that
Hmm.
are actually really relevant. Like, like it's really important. On About.me, I'll give you an example. Getting people to set up a page. Yes, as like all we were focused about, speed, time, is the page good, all that kind of stuff. And then we realized like, okay, that's kind of table stakes. And that's like, we knew we were doing that. So we didn't really need to track all those metrics after a while in the same way. We tracked them, but I didn't need to spend time on them on Monday morning. What I need to spend time on Monday morning was how many people actually put a link to their About.me page in their email signature, or they put it in their LinkedIn bio, or they put it in their Instagram bio page or Twitter. That's the stuff. Like, I didn't realize that when we started the company, but that started becoming our, kind of North Star and our guidepost for understanding, are we on track and are we developing this business in a very capital efficient and smart, compelling way? And so as an entrepreneur, you've got to be really nimble, and you got to be thinking about that stuff all the time, right? Because
Hmm.
it would change. And if About.me had continued on, then I wouldn't have gotten into a lot, or we would have gotten, it's never I, but we would have gotten into a lot of things around, revenue and, partnerships and just all kinds of different things that would have been new metrics for us to track and get obsessed with.
Mm. So are you technical?
No, not really. I mean, you have to have, I mean, if you're working in venture capital and you're going to work, in technically driven businesses, you got to have some aptitude. I got to be able to figure out how to set up, you had me do like Yardbird, or what is it called?
I know StreamYard. Yeah.
StreamYard.
StreamYard,
Sorry,
if you're
sorry,
listening,
StreamYard.
sponsor us, because I personally onboarded the most like
Yeah.
amazing, exquisite investors from Silicon Valley, like Tony. So please
And
sponsor us. At this point, it's so bad because I do not ever use the code. But anyway,
yeah, well,
okay.
anyways, but like you just need to feel confident that you can do that. And you and I sorted this all out like in 30 seconds, right? That doesn't make me any technical prowess to do that, but you cannot be afraid of technology. You cannot be afraid to get into it. Am I
Yeah.
sitting around coding? No, I am not doing that.
Okay, but how do you convince someone technical to build a product with you?
Because business is not, I mean, in part, you have to have great technical chops,
Mhm.
right? And so I need to be confident that they have the people on their team who actually know how to do that and do it at an incredibly high level, innovative level,
Mhm.
leveraging today's tools, But for me, like I never talk about technical stuff with the with the
Mhm.
with the founders. Like I'm talking about all the other stuff that matters. Like the Valley's, the Valley floor is littered with amazing technologies that never understood how to go to market, never understood how to build a culture, never understood all the soft aspects of leadership, operational excellence. All that stuff is what goes into building a business. And that's what I focus on. And when I talk to founders, that's the things that I want to impress upon them that we're obsessed with, right? We're obsessed
Mhm.
with, emotional intelligence. I think you've had Paneet on here, my partner Paneet, who is, there's a, by the way, go Google it, everybody. There's a
Mhm.
Stanford, or we can put it in show notes if you do that, Grace.
Mhm.
There's a talk he did at Stanford about EQ and the role of it in venture capital versus
Mhm.
IQ. Of course,
Mhm.
everybody needs to be smart, but it's
Mhm.
not necessarily a gift to be the smartest person in the room, right?
Mhm. Mhm.
It is a gift to be the most emotionally, intelligent person in the room, the person thinking about that kind of stuff. So that's the kind of stuff that we sell founders on.
Mm. I wonder when you're thinking about like fund building. So like I know that True started very early on in the I always call it like the seed space or like right now it's like a popular space to be in, but back in time it was like not very popular. And I wonder how do you create like a sustainable um unfair advantage to yourself as a fund?
Well, you have to be disciplined. We're in our 20th year. This
Mhm.
summer will be our 20th year.
Congratulations.
Thank you. And we have $5 billion, well, $4.5 billion under management. And
Mhm.
as I mentioned, 8 core funds and really kind of 13, 14 funds in total. So when we started, and it's really, John, my partners, John Callahan and Phil Black started, and then Tony Schneider, my partner, and I were also part of the team. But Phil and John are really the founders of True, and, they saw a need.
Mhm.
Move away from friends and family and kind of angel checks, and felt like there was an opportunity for true kind of seed capital. We called it
Mhm.
Series A at the time, but
Mhm.
true seed capital or pre-seed now.
Mhm.
There was us, Josh Koppelman and his team over at First Round were also kind of figuring that out, and Fred Wilson and Brad and the team over at Union Square Ventures also were on it.
Mhm.
So we were the three firms really doing it, and there might have
Mhm.
been a handful of others, but it was really the three of us.
Mhm.
People thought we were a little crazy, like it was just too
Mhm.
risky,
Mhm.
and like we're like, no, this is a moment where we can get involved with a company, we can create emotional intelligence around the company, we can put a certain level of safety in the way that the working relationship works between a venture capitalist, or an investor and a founder. And there's all these kinds of things that we can do that really set the company up to be successful in a long-term basis, right? And be
Mhm.
great capital partners. And so that was the original idea, and it obviously worked.
Mhm.
Our three funds have been part of some of the biggest outcomes in Silicon Valley, but they all started with those kind of early pre-seed checks.
I
Our first fund, our average
Mhm.
check, this is insane, was
Mhm.
700. I think somebody on my team might ping me and go, that was false, but it's directionally it's not off by a couple hundred
Mhm.
thousand. I think it was like 750 or $780,000 for 20% ownership.
Yeah,
It's
wow. In
really
today's age, it's very challenging.
today our last fund, it was $2.6 million. So
Mhm.
we've stayed true to our knitting and our focus and our vision.
True.
Even though there are a gazillion options out there, we still think we're one of the best. And I think in the current cohort, it's closer. It's starting to creep up around 3.2 million, right, for 20%.
Um, I'm just taking notes. I wonder, how do you think about like the consistency of building the fund? Like, so, and then the like from sourcing, maybe you could talk about like how do you even meet James from Blue Bottle or like the, Sweet Green team or Slack team? Like, I guess how do you like walk us through like the meeting journey, and like how do you kind of like getting in, because some of the deals could be really tough to get in, like a Slack or something, but like how do you position yourself to always getting into a hot deal? Obviously, I feel like Slack is not the best example, just because we had investor who invested in Slack before. They were saying it was a gaming company, and then
It was, yeah.
they're like, yeah,
But you know what's true? But you
yeah.
know what? But that's the point. So what? It was a gaming company. Guess what we were investing in? Stewart Butterfield.
Mhm.
That's what we were investing in, right?
Totally.
We were investing in his vision for gaming,
Mhm.
but within that, within that game universe, which wasn't working, and
Mhm.
they knew it. He knew it. They
Mhm.
had an IRC channel for the OGs and of tech here, right?
Mhm.
They had an IRC channel which they were just communicating for doing project management, and they realized, oh my God, that's a
Mhm.
much faster and efficient way, for communication. So,
Mhm.
and I at when we were building About.me, our team was, I think we were we may have been literally the first external client. If not, we were certainly one of the
Mhm.
first three. And I was on their webpage, the front of their
Mhm.
webpage for a couple of years, right? As why we used it, how we used it as this collaboration, product management tool within the thing. But your question is interesting, around how do you, so the early work, and we always need to remember this, and I think this is why we're non-attribution as a fund, even though
Mhm.
people know, and and like you pointed out, things that I've been heavily involved in, but like as a fund and as a culture, we try to be non-attribution. Do you as a founder have a lead from our team? Absolutely. Right. But
Mhm.
we work as a team, and you have access truly to the entire partnership, right, to help
Mhm.
you build your business. And it's my job to make sure that you feel comfortable accessing all of my partners and all the resources that we have. But you win deals. um, in the beginning, you got to be scrappy, and you got to be out there, and you got to hustle, and you don't have a
Mhm.
reputation, so you can't lean on that. You don't have a track record, so you can't lean on that. And so you got to get a
Mhm.
little lucky, and you got to push really hard. But
Mhm.
once you've done that hard work, never forget the reason why we might win a really super hot open source deal in AI today is because maybe we won that deal so long ago on WordPress or Automatic, right? Which
Mhm.
is the OG of OG in terms of open source companies. So I never forget this, that there's so many things that I'm so fortunate to get to lead on our behalf, but it's not never like think it's like the greatness of me because
Mhm.
it's not. Check your ego. It's
Mhm.
like our firm reputation helped us to win that, and our previous experiences we're able to build on. We got Sweet Green because of Blue Bottle,
Mhm.
the work we did in Blue Bottle. If we didn't do Blue Bottle, there's no way we ever did Sweet Green, right? And so
Mhm.
these things build over time, and you have to always recognize that and understand the reality of that.
Mhm. So, hi Victor. Wanted to say hi to the audience. Okay, so I wonder, when you're a lot of like listeners are emerging managers. I'm sure you probably invest in like emerging managers fund as an LP, or like at least advising some. So I feel like for emerging managers, like typically people have like a subject expertise area, or like they have a community they're rally against. Let's call it like fintech or whatever. So how do you think about like, as an emerging manager, how should you go about your fund to build like a sustainable advantage, since you have building True for like the past 20 years? You obviously have seen like, what has been like successful for your fund. Obviously not everybody will have the same advantage True has, but like I guess like what's some like lessons that you think emerging managers should know to like kind of build their own brand within the ecosystem, since I feel like a lot of like the bigger funds trying to source from emerging, but like, one day the emerging have to be bigger, so like people are always shooting for like the fund 4 5
Yeah.
6, even they're in fund one. But how do you think about having a competitive like advantage to like, grow the fund while the size becoming something?
Yeah. Well, there's a bunch of different things that go into this, right? First you have to have strategy, which is what we were just talking about. So in the case, of us being like the first institutional investors in early stage, that was a strategy. And if that had not worked, then it would have been really important for us early on to understand that and move off it, right? And figure out what the strategy was. We got lucky and that worked. And so, we need to be consistent with that, and we need to evolve it over time to make sure that it's sustainable, right? And moves into the future. It's about the team that you put around the table and the culture that you create. You have to have really, like, we have a non-consensus culture. We have a non-attribution culture. We have a highly, what I'll call EQ culture, a team-oriented culture. We understand that within the partnership, there might be certain partners who put points on the board at a higher level. And there might be other partners who don't. It doesn't necessarily mean they're not valuable, right? And, this is such the culture of venture capital is so upside down most of the time. Like, most of the firms are really messy. Like, they really are. And I'm proud that ours has never been in 20 years. Because we've always kind of understood all those things, those basic building blocks. So you have to have a philosophy first and foremost of how you operate. Then you have to have discipline around the execution of that. And there's real operational excellence that has to go into building a fund. So for us, there's all kinds of things we could have done early on. Like, we were running in the right circles. All of our friends were starting companies like Twitter and LinkedIn and Zynga and all these kinds of things. And, we missed a lot of those, and which is fine. It's natural. And then there were subsequent points where we could have just put money into those. And, it would have been fabulous to have invested in Twitter's Series C. And we shouldn't, pretty sure could have gone to Ev and squeezed in 5 million from our fund or 10 million as part of a round. I mean, I don't know, but I suspect, right? But we never did that, and people here listening might be going, well, your job is to make money. No, your job is to build a sustainable, machine that knows how to make money. Right. And so, have we done that $5 or $10 million Series C check and kind of chasing the shiny object, the silver bullets for success, maybe we wouldn't have done Fitbit. We wouldn't have had the money to do it, right? Because that's real. Because at the end of our first fund, right, and when you cross over to your next fund, there's always an investment that is the first investment in that next fund, right? Right? Or there's the one that's the last investment of that fund. Fitbit has to do that for us. Right? We would not have done that. The $5 million would have gone out to Pandora or, like one of those kind of companies. Great return. But like, we made over, a couple $1 billion on Fitbit. Like, we would never made that as being a Series C investor in any of those other companies. Right? So it's not on strategy. So you have to really adhere to your strategy and execute against it. Now, as you grow and you get older, not in age, but as a firm, there are opportunities occasionally where you do act opportunistically. And we have given ourselves permission in each fund to have a couple of those. I don't think we ever go beyond that. There just might be one where we put $10 million in as our first check. So Peloton would be a good example of that. One of our partners, was a personal investor in it at seed. And Peloton famously is a company that went out. John Foley pitched, I don't know, I think he said over 100 and some venture capital firms and got no's, because I can see why. Like, it's like hardware. They're building their own software model. They're building their own tablets. They got to build a studio. They got to build content. I mean, oh my God. As a venture capitalist, you're like, which business are you in? Just go build the hardware or just go build the studio, right? So it didn't feel like a venture business, but boy, really early on, we figured out it was, and we put $10 million in. We checked our ego and we're like, we're going to do that. fast forward, I think we made a return of, nearly $3 billion for our investors, on Peloton. So you have to have discipline.
Mm. I wonder, so like I'm thinking about from like a fund construction. So like thinking about for like a smaller fund, let's call it like a $10 million fund, you invest in like 40, 50 company, 200K or below in like check size. But like, how do you think about, I'm sure you have to hit like maybe call it like one $4 billion, $5 billion exit, and then the rest maybe like collectively hit that. Is that realistic, or like based off your experience, like you should go for like a higher concentration model?
I think you should go for higher concentration, because ownership is in your winners is what you need, right? And winners establish themselves pretty quickly, especially now. So every one of our funds has, I think we had one fund that broke this rule, and we got lucky on that fund. But we had some heartache. I think it was our third one. It was really challenging because we ran out of reserves. So every fund has about 45 to 55 companies that are our core deals, right? It doesn't matter.
Wait, sorry. You mentioned like it should be more concentrated, but why this 40-50?
Well, because our funds are larger. So,
right. Sorry. Forgot about the $1 billion fund.
Our current fund is, it's almost $900 million.
Right. Yeah.
That also encompasses a growth vehicle. So it's about a $500-600 million fund, right? So, but in each one of these funds, and you adjust for inflation, and things cost more to get your median ownership. They cost more.
Of course. Yeah.
We look at it and we want to have somewhere between 45 and 55 companies. In that fund 3, I think we got up to 60. And so therefore we had the problem where a lot of those businesses were working. And so we ran out of money. It's a good problem, right? But it's also, it's vulnerable, and you need to protect.
Do you just raise like SPVs after that if you run out of money, or like do you have to raise like a separate fund?
Well, we went back. That's how we ended up having, what we call our opportunity funds, our growth funds, which allow us to invest across any vintage, meaning any fund 1, 2, 3, 4, 5, 6, 7, or 8, or whatever. It does not matter. We can put money from that pool of capital in our existing companies. It's not meant for going out and putting money in ChatGPT in the Series D round, right? About, backing up our existing companies. So that was a vehicle that we created for that. It worked out fantastic. But let's go back to construction of your portfolio. If you're a $10 million fund manager, I would argue that you got to really play very aggressively and very early, right? So you can have a small, whatever that check is, might feel large, but 250 to 500K, get as much ownership as you can there. And then have as much reserve to be able to play along to maintain some semblance of that ownership, as you go. So I would rather see, I'm just going to make this up, but like I'd rather see a $10 million fund have 10 companies in it, of which, one looks like it can be an outlier for success, and it ends up consuming, $2 million of the $10 million in total. 20% is kind of about the max.
Wow. That's bold, man.
Well, that is bold, but that is what you need to do sometimes. I mean, we've had companies in our portfolio where we have $90 to $100 million in total capital invested. Like, think about that, right? It ends up being close to 15 to 20% of the fund in one company. I think we had $92 million total in Peloton. We have an incredible company out of Finland called ISI in the space, robotic space. Space or whatever. It's too many spaces.
But
that one of our partners is leading, and probably can be a, I don't want to cap it, but it feels like an uncapped company. Like it's one of those decacorn, multi-decacorn type companies.
Oh, yeah. Sorry.
You want to own your 15, 17, 18% as you get diluted down, or whatever it is for a small fund.
How do you know which company is the 20% company? Because I feel like at the very early stage, like it's kind of hard to tell who's gonna be the winner. Or maybe it is. Like you think it is? Or
Uh, no, because even in our opportunity funds, we have companies, that have 25, $30 million and ultimately have not worked out. Sometimes they don't work out because the markets tank, or there's a fundamental shift in technology and we just didn't see it. Or there is, you can get in trouble with misalignment in your investors. The different stages they come in, back to that valuation question, be careful, like a series, a private equity, a true private equity firm, a PE firm, not an early stage venture capital firm. All are called private equity, but like James Joaquin at Obvious Ventures once said to me, like, we're like different sea creatures. We're in the same ocean, but we're very different sea creatures. Like one might be a shark and one might be a dolphin. Very different. So you can get stuff where your cap table gets upside down, it gets mixed up. There's different incentives for investors at different stages, and it creates complexity. And ultimately, the company can't raise follow-on capital because because smart investors downstream look at that and go, "That's a mess." That just happened to us, and unfortunately me in particular, on a pretty high-profile deal last year, and we had $31 million, and you know what? It's a zero, and that's on us. It's on me, but it's on us, as a firm. That's the risk we took. But, 5 of those others are going to become monster companies. And it doesn't matter.
Okay. So another question is like, I'm sure like by this point, I don't know if you like personally go raise funding for the fund or not, but like I'm sure all the partner probably meet the LPs. How do you take LP feedback? So let's say if a person told you X and then the other person told you Y, that's like literally 2 different directions from 2 different person. So some people would tell you, do I don't know, like only invest in like X type of
most of the time when that happened, by the way, that hasn't really happened to us, but in theory, if it did happen, my guess is your job at that moment is to dig deeper into the feedback, because there's probably more commonality than you think on the surface. The surface comments can be pretty shallow and feel very black and white and directional. The reality is they're probably closer to gray, and you might, you're getting that feedback for a reason, and you probably need to pay attention to it, right? And think through and course correct if necessary, or help people to bring people along because you're pretty sure you've got the right answer and you're on the right path. And that's just good management across any piece of this equation. The answer is, though, I don't, like we all, of course, are participate in raising capital, right? But that is not something that I enjoy doing, and have never thought I was actually very good at that. I'm good at it.
Are you sure? Didn't you raise for your own companies?
Well, for that's different, but in terms of the fun stuff and, the institutional investors in that, my partners, John and Phil and Paneet and Jim Stewart was our CFO, and Uli, who is our CFO now. And I mean, this is just, they have such a great natural ability to partner with those folks, and they enjoy doing it, and they're great at it. And they're great stewards of their capital, and they're great stewards of our firm's reputation. And so, they do most of that work. And at the right juncture, of course, they wheel each of us out, like if necessary. But, that's the magic of all that for True is that's not me. I'm a part of it. It's not me.
What about like, since you're in the firm for like over 20 years, and then like I feel like the core partnership did not really change, right? So like it's like the same group of people basically. How do you have like a company or like a firm culture that just like more sustainable? Did everybody already work together for the past like 55 years or like not 55?
No. Interestingly, John, Phil, and I had all worked in venture, briefly with other firms, and we'd had what we felt were somewhat uneven experiences, you know,
Mhm.
not as individuals, but as investors, but as a group. And we felt like it wasn't optimal. It was very suboptimal, really, culturally. A lot of the stuff that is all of us know, like that the infighting that
Mhm.
happens, the lack of succession, the lack of maturity, like, ownership. It's my deal, your deal. I'll trade you, on, you know,
Mhm.
hey, if you'll vote for mine, I'll vote for yours because it's consensus driven, all that stuff. And that's the reason why we got rid of that. That's why we said day one, like, let's
Mhm.
just do non-attribution as a firm.
Mhm.
Let's focus in on, partnership. Let's focus in on team building. Let's focus in on, like, you know, the truth is, like, for us, once we realize, and it takes a while in this industry, you start a
Mhm.
fund, you're probably not going to know the answer for 5 years if it's working or not,
Mhm.
and maybe not 10 years until you actually get into the carry and really results and all that kind of stuff. So you got to have a lot of faith.
Mhm.
But once you do see it working, check your ego. Even if you drove a lot of that, always remember it's a team sport. It's a
Mhm.
team accomplishment. There's somebody's whispering in my ear the right advice or the right motivation or the right confidence, creating a sense of safety, not fear. All that kind of stuff as a partnership has worked. And it's unquestionable that True has been a top decile fund in the Valley. We have won. We are winning. We are doing great. So what needs to change? Right? We can optimize. And obviously, we have brought in a lot more talent on our team and diversified our team and done all kinds of great things. And, you know, we're we're so well prepared for the immediate future and the mid future and the long term future because of the culture that we have created, right? Like somebody like myself, I'm obviously towards the latter part, if not the end of my career in venture.
Mhm.
How we as a team handle succession. I'm not leaving, by the way.
Mhm.
But that's on the horizon, and I can see
Mhm.
it really clear. We all can see it, and it's sad, but like that has to happen, and how we model that for our team in itself is the next chapter of True, and a gift to True as a brand, True as an institution, and to those individuals on this is how it's done. This is how we do
Mhm.
it our way, the True way. And
Mhm.
um,
Deep.
there you go.
Um, okay, so I wanna be mindful of the time. I have two real questions and then quick one if I run. Okay, one real question is like, how do you examine the culture at the very beginning? Because when let's say you first meet John and Phil, like immediately, like do you just feel the vibe or like how is everyone? Because like I feel like a lot of the relationships at the very beginning, it was more towards like, one person have the conviction for the entire crew and then people slowly build up the trust. Then everybody just bond immediately, become best friends, right? So like, how do you kind of like vibe with other
I think
people
that's
and at a
really,
work condition, not
yeah,
just friends, right?
I think it's really interesting. Um, there was actually five of us, and one
Right.
person was on the East Coast. It just geographically didn't work, and so very early on they transitioned, but that was smooth and easy, no drama, and I think that's kind of the only time we've had
Yeah,
that.
no drama. We're on a podcast.
But the four, so there was John and Phil who knew each other. They had worked
Mhm.
together at I think Spectrum. I'm getting that wrong. I should kind of
Mhm.
believe I'm forgetting. It doesn't matter. They'd worked together early on. Tony Schneider and myself had worked together
Mhm.
um, on a company called Oddpost, which was a pretty well known company, and that was
Mhm.
when I was investing elsewhere.
Mhm.
And Phil and I knew each other, but
Mhm.
none of us were hanging out together. Maybe Phil and Tony might have been hanging out together a little bit. They had
Mhm.
kids across the street from each other, so they were neighbors. Um, but none of us were hanging out together on the weekends. And in fact, for a
Mhm.
very long time, we never did hang out together.
Mhm.
It just had a very slow. Um, it just cooked very slowly, naturally. And I mean, I can tell you wholeheartedly that these are my people. These are my first
Mhm.
call. These are the people when I'm batshit crazy, or I'm enthusiastic and I need to be brought down, or, or I got a health thing, or I got a family thing, or like, this is my first call. That these are true friends at this point in time, but we're not hanging out socializing.
Mhm.
Like, I can, like, in 20 years, I think, outside of work, maybe the four of us have had 4 or 5 meals together.
Oh,
What I
really?
mean? Well,
What? I'm sorry. Are you kidding me?
as a group, we're like
Oh, okay.
went to a restaurant and
Wait,
like got
so you
together.
don't do like the
Like,
I don't know, annual AGM every
yeah,
day or
yeah,
something, or
well, I see them all the time and I talk to them all the time, and I see, I my partner Phil, I do see socially, and we do have a lot of common friends now and that kind of stuff, but like, not in the beginning. That's not what it was. But what we had was certainly the three of us having seen the belly of the beast and how
Mhm.
kind of unproductive and ego driven that it could be, that we understood. That was the commonality that we had when we all came together. And Phil and John
Mhm.
really established that. And they brought Tony and I along, with it. And, I'm so incredibly thankful, for what we've built and how we've done it, because it's with grace and affection and professionalism. I mean, it's just
Yeah.
as good as it can get.
How do you solve like a challenge? So let's say if like I feel like if everybody agree on everything, that's amazing, right? But like I feel
We
like
disagree on everything.
yeah,
We disagree on a lot, you
even
know.
now, I feel like after you
Yeah,
work together with
I mean,
someone,
less and less and less and less, of
right?
course,
Okay.
right? But you have to you have to build a muscle on how to work together. I always say that for boards, like, on one level, you don't want to like micromanage, and you don't want to create complexity for a founder early on. You want to create a lot of space for them to be able to operate. But it's also important that we as a board or a collection of investors develop a muscle on how to work together, because we're going to get to some shit moments.
Mm-hmm.
We're going to get some wow moments too, right? And we just need to know how to manage and work together. So we did that over a long period of time. And like, none of us, I'll take myself, I can speak for myself really easily. There's lots of deals, I probably should not have done. There's lots of deals I ended up not doing that I'm glad I did not do. And the commonality in that is my partner's kind of new. But they learned to let me, or they had enough confidence in the overall picture that they would allow me to make mistakes, and did not jam me, and not I didn't, like, I'm fiercely independent. We're all fiercely independent. Probably most people in our ecosystem and community are fiercely independent. We don't want to work for somebody. I don't want to work for the man or for the woman. Like, I don't want anybody's thumb on me. And I want to be able to be considered somebody who can take inputs and then make a good decision. And by the way, I've gone against some of those inputs, and they've been phenomenal decisions for us, right? For time. And so we've just learned to let each other, we learn to hear, not to tell you what to do, but to share our best advice.
Mm.
Create a space where you can hear it and don't get defensive. And that's what we knew to do early on. And it just got stronger and stronger and stronger. And today it's our superpower, as a firm. It's not just the four of us, it's the entire firm operates that way.
Wow. I love that. Love that for you. Okay, so quick 1 minute fire round. What's your favorite book?
Oh my gosh, I have a lot, but In Praise of Shadows. It's by a Japanese author. It was written in the early 20th century. It's about Japanese design. It's a book that I can read really easily because it's about 100 pages. I've read it probably 10 times. And I just love the attention to detail. And I was going to put a face to a book and say, like, who's the person in my life that I think should be on the cover of that book, James Freeman would be on the cover of that book.
Oh, wow.
That's a bonus for you. You could ask that question later on. Who would be the person that would read that book?
Yeah.
I love
Wow. Who made the biggest impact in your career?
Oh, that's impossible. People will ask mentors and stuff like that. And I always say, like, well, it's not one person, I mean, there's those people at Danone who trusted me they listened to me and took me seriously. And I mean, that obviously experience had a huge impact on me. There's my wife and my family that, has called out my bullshit, at the right moments, and also empowered me in lots of different ways. There's Phil and John and Tony and our team, and, that I've talked about, a lot here, and Paneet and the whole crew. There's Tony. There's Tony Hawk that's taught me the value of, check your ego.
Wait, you're on the Tony Hawk Foundation. Is that the skateboarder or no?
Yeah. He's.
Oh, wow.
Tony Hawk's probably one of the most famous people in the world.
I know.
And he's instantly recognizable everywhere he goes. But Tony is low ego.
How do you meet these people?
Well, it doesn't even matter. I mean, we could go down that rat hole. But what's the
Burning Man? I'm just kidding.
No, gosh, no, I'm not. That's not me. I've been once for
research reasons.
but Tony's taught me the value of kindness and taught me the value of giving back. There's Matt that I mentioned earlier. There's probably no entrepreneur I've worked with that I've learned more from. I continue to learn from. In fact, I learned something from him yesterday that we won't go into, but that was really powerful for me. And then there is always, it's so dynamic. There's young people. We always think of this stuff as age in a hierarchical way, that you're the mentor because you're older. I've had, tremendous, opportunities to meet lots of really fun people. There's John Gray, who runs Ghetto Gastro, out of Brooklyn. There's Moses Moody, who's a Warriors player who I've been getting to know over the last year, and who's probably one of the most inquisitive young people I've ever been around, and seeking knowledge. And he has no idea how much I'm getting from him. Has no clue how much I take from him. There's the young team members. There's Sean and Sol and Caroline and Michaela on our team that, are somewhere between 23 and 26. And, I know they think they're, that they're being mentored. They have no idea how much I'm getting from them. So it's a very dynamic, fluid thing. And if you're open to it, you'll find it in lots of corners of your life, and embrace it and double down on it. And when it's nasty and not right, move off it.
Who would you invite to your dinner party?
Who would I invite to my dinner party? Oh gosh. I mean, I have so many of them. I'm not going to do that because who am I going to leave out? I mean, I have I have different friend groups that are in and outside of tech. I mean, I have a group, that lives up in Bolinas where I have a house. There's, Eve Bahar, who's a designer, and his wife, Sabrina Buell, who's in the art space. And there's Eric McDougall, and who's just
so many, everyone's name. You remember everyone's name.
And there's Carol, there's Claudia, Eric's wife, who works in crypto, and there's Mimi, who worked at Cruise, and there's Mark, Mark Pincus, who is techie, and his wife Hillary, or his partner Hillary. I don't know. That's one dinner party, but there's, we could go have one over here with Thomas McNaughton from Flower and Water, or Dominique Crenn. There's lots of different things. And I mean, they're all just people, I used to always laugh when I'd come back to the US. Every once in a while, it's like eating Cheetos or something, or going to McDonald's. I would see People magazine on the rack, and I'd going to grab that. You know, I kind of read through it. And they had this section. I can't remember if it was People or Us Weekly or whatever. By the way, I don't read those things, just so everybody knows. Like, I'm not, don't.
You're not that person. You want to differentiate yourself.
I'm at the doctor's office for sure. But like, anyways, and they had this section where you open it up and it would be like Tom Cruise walking out, you know, like tripping or walking out of a Starbucks, or Nicole Kidman doing, and they're like, yes, they drink coffee just like you. They trip just like you. And all these people, yes, they might be fancy and they might have big names and they might whatever. At the end of the day, they're just really good people. And that's why you're in your kind of your friend groups. And, you know, I could name hundreds of people that I love and that you don't know their name, and you're never going to probably know their name, and it does not matter. They're just as important, right? For every Tony Hawk, there's 100 of those that are just as important. That does not matter.
Wow, deep. Where can we find you outside of work?
Where can you find me at work?
Outside of work.
Oh, outside of work. Yeah, you find me, let's see, what do I like to do? I like to do a lot of things. You often find me in a coffee shop. I'm a nerd that way. That's probably why James and I bonded. I was a nerd before we invested. You know, I love all things cultural. I love social. I love interacting with human beings. I love going to the ocean. I'm lucky to have a house in the countryside that's, you know, up in Point Reyes National Seashore that I love. It's silent. It's very zen. Yeah, you find me. Yeah, there you go. There, you know, sometimes on my scooter. If I'm in Paris, I'll be on my scooter. I have an electric scooter.
Only in Paris.
I keep, it's a great urban thing to have. I leave it with a friend, and if I'm in Paris, which I do, I'll go frequently. I'm on a board of a company there. I ride it around all the time. I love it. It's great. It's freeing.
Wow. That sounds like an amazing life. Wanted to quickly say hi to Yusuf. Hi, before we but Tony, thank you so much for coming on the show. It was such a fun conversation. You're such a human being. Sorry.
I'm a robot. I promise you, I'm AI driven. Thank you. By the way, we didn't even talk about AI today. That was great.
Okay. So you made me forget about AI. That's a compliment for you.
Thank you. Well, listen, I've seen your show. I've seen a lot of the folks on it. They punch at a much higher IQ than I do, but hopefully I've added something to the mix here for people to think about.
Love that. Thank you so much, Tony. Okay, let me quickly end stream. It's about to end.